In today's video, we're going to compare some of the high-yielding PIMCO closed-end funds using a variety of different metrics. We're going to look at the overall performance of each fund, their dividend histories, their performance as of today, and what the future might hold for each fund. At the end of the video, we're going to determine which of the PIMCO funds might be the best, although most of these funds we're going to look at are suitable for any investor looking for consistent income. The closed-end funds we're going to look at for this video are a combination of the highest yielding funds they offer as of right now and what I believe are some of the most discussed funds in the comments section of my videos. The funds we're going to examine today are the Dynamic Income Fund, ticker PDI, Strategic Income Fund, ticker RCS, the PCM Fund, ticker PCM, the Corporate and Income Opportunity Fund, ticker PTY, the High Income Fund, ticker PHK, and the Dynamic Income Opportunities Fund, ticker PDO. There will be some challenges in comparing all of these funds to each other. For example, some of these funds have been around for decades and decades, whereas one of these funds has only been around for about 2 years. So I'll let you all know when we run into one of those situations. We'll start by comparing the current dividend yield of each fund by using the information from Yahoo Finance. Every fund we're looking at currently has a dividend yield of at least 10%. We can see in first place is PDI with a current dividend yield of 13.03%, followed by PHK with a yield of 11.98%, and then we have RCS with a dividend yield of 11.42%. With this in mind, the clear winner in the first category is going to be PDI for having the highest current dividend yield. As I always say though, you shouldn't just invest in something that offers the highest dividend yield because we don't know if it's going to be sustainable. So we're going to look at a bunch of other metrics throughout this video to see if this yield is going to be sustainable going forward. Next, we'll see which of these funds offer monthly dividends. Any fund that pays monthly is something I consider to be a major advantage, but just as the case with the last category, just because something pays monthly as opposed to quarterly doesn't mean we should prioritize it over a quarterly paying holding if it's not going to be sustainable. An 8% yielding quarterly paying dividend stock should always be prioritized over an 8% yielding monthly paying stock if the monthly paying stock has a history of dividend cuts. Fortunately for this comparison, every fund we're looking at pays monthly dividends as of the making of this video. Next, we'll take a look at the dividend history for each fund. To get a checkmark in this category, a fund cannot be paying less dividends than it did at its IPO. Some of these funds have a history of raising their dividends and decreasing them throughout the years. So for example, a fund might be paying 7 cents to begin with at its IPO, grow it to 10 cents per share per month at one point, but then today it now pays 8 cents per share. In this example, this fund would get a check because it pays more than it did at the start of this fund's launch. And again, like I mentioned at the start of this video, some of these funds have been around for much longer than others. Going through the dividend histories for each fund, we have 3 funds that get a check in this category. PDI, PCM, and PDO have never cut their dividends throughout their history, but PDO has only been around for about 2 years. Ticker PHK stands out for having gone through a bloodbath in terms of dividend distributions. Originally paying 12.19 cents per share per month in dividends, today now pays 4.8 cents per share. In terms of dividend distributions, it's been the worst performer, which is sad. All of the other funds haven't really seen their dividends decrease by more than a penny or two, which still makes them worthy of consideration in my opinion. And I also didn't take special dividends into consideration since they aren't something that can be predicted. Next, we'll examine each fund's average yearly return from the last decade. For this, I'll be using the Dividend Channel DRIP calculator, which calculates the total return of a dividend stock and assumes you'll be reinvesting all of your dividends back into buying more shares of the same stock. You can go to dividendchannel.com and feel free to enter your own ticker symbols and your own date ranges for yourself. But with the exception of PDO, which I only have 2 years of data for, what I'm going to do is I'm going to look at the average yearly return for each holding going back to 2012. I know it's not going to be entirely fair for PDO, and I wish I could go back further, but these funds just vary a lot in terms of how long ago they were launched, so I just went with the last 10 years. From the results, we can see that PDI is again the clear winner in this category with an average annual return of 8.81%, assuming dividends were reinvested. PTY comes in second with an average annual return of 7.33%, and PDO is the only fund here to see their average annual return be in the red, but again, this is only because this fund is less than 2 years old. It was honestly just a bad time to be launching a fund, but for this category, the check is going to have to go again to the PIMCO Dynamic Income Fund. PDI is also one of the younger funds on this list, and PCM is the oldest fund on this list, having been launched all the way back in 1993. Moving on, we're going to now look at the expense ratio for each fund. This is the cost of owning a fund that the administration charges investors. Closed-end funds typically charge much higher expense ratios than ETFs for a few reasons. CEFs are almost always actively managed, and a lot of them use leverage in order to boost returns. So every single one of these funds probably has a higher expense ratio than every single ETF that you own. I know a lot of people who are concerned about expense ratios, so I know this is going to be concerning to a few of you. Only one of these funds will get a check in this category, and it's going to go to the fund that charges the lowest expense ratio out of the bunch. All of this information is going to be taken from the PIMCO website. You can see the results here show that PTY, the Corporate and Income Opportunity Fund, charges the lowest expense ratio at 1.13%, followed by PHK at 1.18%. The top fund for this comparison, PDI, carries a really high expense ratio at 2.64%, which is really high even by most CEF standards. But the worst fund in terms of cost has to go to PDO at 2.79%. This is also the fund that had an average annual return of negative 5.53%, but since there's only 2 years of data, I don't think this is entirely fair. But for this category, the checkmark is going to have to go to PTY. The next metric we're going to look at is if the fund is currently trading at a premium or a discount to its net asset value. It's an important metric that's unique to closed-end funds that both ETFs and mutual funds don't really have to worry about. For closed-end funds, the value of what's inside the fund might be more or less valuable than what the fund is actually trading for. It's typically ideal to buy into a closed-end fund that's close to or trading at a discount to its share price. It is a little complicated if you're not too familiar, and you have to kind of treat it on a case-by-case situation. Funds with better performance typically always have share prices that are at a premium to their net asset value. But for this metric, the bigger the discount to the share price, the better. For this, I'll be using the website cefconnect.com, which has all the information already calculated. All of these funds are currently trading at a premium to their NAV, but some of them are more fairly priced than others. The fund in first place is PHK, which is currently trading at just a 3% premium, followed by PDO, which is at a 6.46% premium, which isn't bad. The worst is RCS at 20.05%, followed by PTY at 19.32%. This means that both these funds are significantly overpriced compared to the value you actually receive inside the NAV. You can go on CEF Connect's website and see what the typical premium or discount for each fund is. I just don't have the time to go through each one for each fund, but PHK gets the check mark for this category. The last metric we'll look at is the dividend coverage percentage for the fiscal year. This is what's known as the undistributed net interest income percentage, or the UNII, for each fund. You can download the report by going to PIMCO's website and scrolling down to their fund's literature. If a closed-end fund has a percentage of over 100%, this means the fund is currently receiving enough money from their investments to cover the current dividend payout. The good news is that every fund currently is at over 100% coverage, but in order to get a check, I'll say the fund must have their coverage be at least 110%. It'll help indicate that there's a little bit of a buffer in their coverage. Also, in their latest report, it only shows the results up to October of this year, so we don't know the full end-of-year coverage just yet. There's 4 funds that are going to get a check in this category, which are PDI, RCS, PHK, and PDO. PDO has the highest fiscal year coverage at 163.06%, followed by PHK with a coverage of 141.73%. PDI and RCS also make the cut at a little over 120 and 119% respectively. PCM and PTY aren't going to be far behind the minimum, but for the sake of this comparison, they aren't going to receive a check this round. So after everything we've looked at today, the clear winner is going to be PDI with 5 out of 7 check marks. It has one of the best dividend yields, and it has one of the best payout histories. I'm kind of disappointed by the rest of the results though, because PHK and PDO both tied for second, but PDO has only been around for about 2 years, and PHK has gone through the most dividend cuts. If I had to say which of these is my personal second favorite, it would probably have to be PCM, because it's probably the best in terms of share price performance up until 2022, and they've never cut their dividend. It's been around much longer than PDO, which would be my second favorite, but it just hasn't been around long enough to make me feel confident. But regardless, these are going to be the results of the test, and feel free to share your thoughts below in the comments section. With that being said, thank you all so much for watching, and until next time, take care.